I I put crashing up here because I want to know, and a lot of people right now want to know what's going on, and is the market crashing per se, and what does that look like? Even I guess what does that even mean? And to me, even if we go back a few years and look at the recession and how that happens, it goes on a line recession, and then so stuff does get a little cheaper, housing gets a little cheaper, but obviously rates are up, so um, because of that, it seems like it's it springs balance, but I could be wrong. What's your take on it? Oh, I know. I'm sorry. I should make sure to introduce you. If this is Greg Siderakis, and he's one of my preferred lenders. And Greg, we do a lot of marketing together, so I do appreciate your time doing this, and appreciate you talking about giving us all your knowledge and everything. And so I know there's a lot of people wondering what's going on, what's going to happen, and no one's really sure. So we'd really appreciate your insight.
Yeah. Well, first of all, thanks for having me on. Always happy to do it, just because I like to clear the air on the mortgage market as well, just because there's so much confusion depending on, what website you look up online can tell you the market's crashing, or the other one is saying buy because it's a great time to buy. And I like to clear the air on that a little bit and look at the statistics and look at the numbers and really weigh it out that way, because that's the only way we really get a clear answer on where the market's at and where it's going. That's how I look at it, at least.
Exactly. Yep.
So there's a lot to unpack in the questions that you just asked, but one of them, is the market crashing? I say absolutely not. Are we going into a recession? I would say yes. Especially considering the GDP numbers that just came out yesterday. They came out at negative 0.9% GDP for the quarter. And that is our second consecutive quarter of negative GDP, which under most people's idea of a recession, that means we are in a recession. But they have not told us yet that we are
backwards on the video, but that's okay. I think that's an important number.
Yes. So negative GDP in general, 2 consecutive quarters of that generally means that we are in a recession. We have not been told yet that we are in a recession, but I think it's becoming clearer and clearer, not only among GDP numbers, but among other numbers as well, that we are either in one or directly going into one right now. So this is our housing market as of right now across the entire country, not Phoenix specific. Because you want to take a snapshot of the market as a whole, not just where we are currently at. So we can look at these numbers here month over month. Home sales fell by 5.4%. That's pretty important, and also to be expected. It's not something that we should be shocked about, because rates are not where they used to be. Less people can afford the same amount of home, and housing prices have increased. So people can afford homes even less than they were able to previously. Housing prices, the average housing price home sale was around $416,000 across the country, which has been a steady increase over the last 2 years, because we are coming from possibly the hottest market ever in terms of home appreciation, 20+% appreciation year over year, 2 years consecutively. So with all of that appreciation that we've seen over the last 2 years, it's only natural and necessary that we see the housing market slow down a little bit. With the housing market slowing down a little bit, though, that does not mean in any way, shape, or form that it's crashing. That just means we're cooling off a bit from lava hotness on the market. So that's not a bad thing at all. It's necessary. We can't be seeing 20% appreciation every year, or else we're not going to be able to have anybody to afford these homes on the market anymore. Another thing that I would say we want to look at, let's see, this is either for the month of June or July. Okay, so homes remained on the market for just 14 days on average in June. Depending on how long you've looked at the housing market, that is still incredibly fast for home sales. Chris, you've been a real estate agent for years now. You know that houses have been selling 45 plus days, and that's
4 months.
very normal.
The average market should be 4 months, the average days on 3 to 4 months, average days on market. So yeah.
Yep. Exactly. So if that doesn't tell you right there that the housing market is not crashing, then I don't know what to tell you, because houses are still selling like hotcakes. There's still much more demand than there is supply. And I know specifically in our Phoenix market, we've seen lots of houses come on in the past couple months, and that's for a variety of reasons, including that every June and July, there's a huge influx of homes that come on the market, because what happens right around that time? Kids get out of school, families are able to up their roots, move over to, a different part of the city, different school district, and not have to, completely change their kids' lives right in the middle of the school year to throw a wrench in the mix, I guess.
I think the other thing to take into consideration that I'm seeing anyway is, panic selling. When people saw rates come up, naturally you want to get the most you can for your house. So a lot of people decided, well, as long as rates are coming up and that means housing prices are going to drop, I better sell now.
Yes, I think so. The amount of volume on the market is a compound of a couple different factors, one of them being the one I just said. The other being that, yes, there were people that were waiting to put their homes on the market because they were waiting to see just how much appreciation they could gain through this extremely hot housing market. And then when things slow down a little bit and more homes pop up, they get scared and start panic selling as well, because they think they're past the mark, which they're already too late by the time they put their houses on the market. You can't list it at 50,000 over anymore and expect it to get 4 cash offers that weekend. But even so, 14 days on the market isn't too bad. If you're listing your home and it's in contract within the first 2 weeks, you can't be too sad about that either. So let's move on to the next slide here.
That's a national average, right? Because I think here in the Valley, we're probably double that. We're a little over a month now for average days.
Yes, so that is the national average. I like to go based on that because it's a larger snapshot of what the economy or the housing market as a whole is doing, rather than specifically in Phoenix. Appreciation rates across the country are not nearly as high as they have been in Phoenix. We've been seeing it's been hotter here than most other places. Vegas, certain places in California are the other ones that follow in line with Phoenix. But another thing that we want to look at, why are rates going up? It's all because of inflation, is what it boils down to. Inflation is what has been driving us towards the recession. It's what's been driving rates higher, and it's what's been making the Fed increase their rates as well to combat inflation. Inflation is still hot, but they're doing a good job to fight it. I think so far they still have a lot of work to do, but we're working towards it. They've increased their rates by 75 basis points just yesterday. They did that the month before, and then I believe it was around 50 basis points the month before that. But
can you define basis points a little bit? That's not like that's not a normal term.
Yeah. Sometimes I get in my mortgage mode and I start using terms that maybe people don't necessarily know. So 75 basis points is 0.75 of 1%. So 100 basis points would be they increase their rates by 1%. So 75 would mean they increased them by 0.75%.
Why don't they just call it a 0.75% increase?
Do they ever make anything easy? Yeah. That's what I think it comes down to. I had to learn basis points myself as well, and I was like,
fair enough. Yeah.
It's not easy for anybody except for people who watch it every day. And for me, basis point is like a common word in my daily life. So sorry, it's easy in my brain, but not so much for everybody else. But they increased rates by 0.75 points. 75 basis points, and that's actually a good thing. As a loan officer, you would expect me to be like, oh my God, 75 basis points increased. Why? We want it to be increasing by 25 basis points. No. And here's why. So the market reacts to inflation more than anything else, right? And the Fed increasing their funds rate does not directly affect our interest rates. So what we can look at is how rates have reacted since that. So this is the past 2 days. We knew about our 75 basis point rate hike from the Fed as of a couple days ago now. It was expected the day before they actually released the information, which is why we saw this huge gain yesterday, and we've been preparing for it. But the past couple of days have been a good time in the mortgage market, which sounds counterintuitive considering they're increasing rates rather than cutting them. That's because the market reacts to fighting inflation. The bigger the rate increases the Fed is doing, the better job they're going to be doing, hopefully, of fighting inflation. And the better job they do of fighting inflation, the better we will be off as a country, and we can get rates back down sooner.
So let me understand that. So
yeah.
Is that kind of from the investor perspective that's, say, purchasing these loans as, you know, debt's just basically leveraged? Are they looking at it saying, okay, well, America is going to be in a good place sooner than later because the Fed's fixing everything, you know, the heavy inflation. So I can then begin to purchase this debt a little bit. It's a safer investment. Am I thinking right kind of on there?
Generally, yeah, that's the right way of thinking about it. From an investor perspective, think about loaning a large sum of money and there is zero inflation. So your $100,000 that you loan somebody today, 6 months from now, let's factor in 10% inflation. Your money is worth 10% less now than it was previously. You're losing money at your 6% interest that you're lending that 100,000 on, because your money that you lended was worth more at that time than it is 6 months down the road with this big inflation. So from an investor standpoint, inflation is your biggest nightmare. It's your worst enemy, because why would you ever want your money to be devalued that you're gaining the interest on? It's better to lend it post-inflation to actually get your money's worth, if that makes sense.
Gotcha. Yeah, I think I understand. So you start off with $10, and in 6 months it's only worth $9 if you kept the cash.
Exactly.
But if it's probably going to stay that $10, then it makes sense to loan it to somebody with a small interest.
Exactly. And that's why interest rates have been skyrocketing, is because the money that they're lending right now is devaluing. And the less that money is worth, the higher interest that they have to charge on it to actually not be losing money by giving you a loan. Your money is worth the most it is today. If it continues to degrade, if inflation continues to increase, it's going to be less down the road. So they have to make money more expensive in the short term. Once everything circles back around, I tell all of our clients this because I believe it to be true through and through. If you're finding a house right now, you're going to marry the house and you're going to date the rate. I love that saying because I believe it absolutely. The house that you buy right now is probably not going to devalue. Like I said, the housing market is still very hot. There's still lots of demand, and you're going to see appreciation if you buy right now. You don't have to worry about your house tanking in value. This is not a 2008 recession where, people are doing loans on houses that don't even exist or don't plan to exist or don't have income in any way, shape, or form to qualify for them. You're going to see appreciation on your homes, but let's say you get your house right now at a 6% interest rate. Yes, it stinks that we're at a 6% interest rate, but that's the industry standard across the board that people are getting. Well, 2 years from now, maybe you'll be able to get a 4% interest rate. Rates will most likely be lower at that point. I definitely expect them to be lower, and the investors do as well. Well, 2 years from now, let's say we have an average of 5% appreciation year over year, you're going to have a 10% more expensive house. So that house that you would have paid $500,000 for at 6% that you decided to wait on is now going to be a $550,000 house at 4%. So are you really ahead by buying at a lower interest rate if you have to buy at a higher purchase price? I definitely would say no, because you can always refinance and get a lower payment than you would be at by waiting.
And that's why you say date the rate, because basically
Yep.
later you're going to dump whatever rate you're on and refinance. And
yeah, you're going to dump it. Exactly. So the rates that you get right now, they're temporary for the vast majority of people. At least some people will stay in their loan. If they're happy with their rate, with their payment, more power to you. That is absolutely up to you. But if you can save yourself a big chunk of money by buying now and then refinancing down the road, then it just makes complete sense, especially if you're renting, because we all know what the interest rate on renting is. No matter how high interest rates are, it's 100%. You're not paying towards anything for yourself towards the end of it. You don't have any tax incentives or anything to go along with to purchasing a home. So that's the way I look at it, at least.
so right now, is this your last slide for the economy in general? Or
You know what? Sorry, I went off on a big tangent.
That's okay. That's okay. But I'll have another question for you later, but you can kind of continue on where you're at.
Okay. So yeah, this is what the securities have been doing over the last quarter. We can see, they were relatively steady. The middle of June came around. We saw really red. It means really bad for interest rates, by the way, just as a general term. Red is bad. We saw a lot of fluctuation, really bad days, some really good days, but it ended up overall lower in this area. We saw it claw its way back up, and now it's kind of on the up again. We've been fighting to get rates a little bit better, and I think that they're going to continue to get better, at least for the short term. So it doesn't look like rates are so bad here, but let's take a look at my next slide, which is the past 6 months. This is the fun stuff right here. So this started, let's see, probably February to March. This is March here, so this would most likely be sometime in February. This is where we started to see rates skyrocket because our inflation started coming into play a lot more.
Mortgage-backed securities. Is this essentially are people purchasing these securities? Is this what, can you define this a little bit better for me?
Yeah, securities are purchased by the Fed. There's something that are traded. There are different bonds that go along with it. I could go down a rabbit hole of treasury securities. They all play into each other, but the 30-year fixed mortgage-backed securities are the best estimate of where rates are going. So this is something that is traded every single day on the market, whether it's by people or government entities, and this is what sets our rates every day when we're working.
So the lower the value of these, the higher the rates.
Yes, exactly. So we can see at the beginning of February, we were having still good rates at that point, probably high 3s, low 4s. I don't really remember exactly what it was at. But over time, we see it's been just a very, very harsh downturn in terms of rates. And this is where we were looking at in June. Look how bad that is right there. So in the past month, if you got a quote on a mortgage and you were pretty sad about it, maybe you should revisit that, because it might have gotten a little better since then. Not up here better, but better than it was before, at least. So we were at 106.428 points. We ended today at 101.655 points, which means a total of 500, or right around 500 basis points difference, which we know our basis points now, that's about 5% in terms of charges, which it doesn't mean that your interest rate is 5% higher, but 5% lower is a bad thing overall. That's the simplest way I can put it. There's so much that goes into it to calculate the interest rates that people get, but that's the most basic way I can put it. So interest rates are higher. I want you to get a 2% interest rate just as bad as you want to get a 2% interest rate, but unfortunately we have to go by, what the market is doing. We don't get to set rates ourselves. But I will work with people as much as I can to get them into a home for as little as they possibly can without spending, tons and points, which is actually becoming a very normal thing now.
Well, and right now, there's historically we've kind of been seeing a lot of success with a set interest rate, right? Is that kind of changing? I'm hearing more about is it called ARMs? Something
Yes.
like yeah.
ARMs, or adjustable rate mortgages is the acronym. ARMs are great in a market like we are in right now, where you are going to be marrying the house and dating the rate, like we said before. So ARMs generally come with a fixed period of 5 or 7 or 10 years, and after that time frame, the rate will begin to adjust by a certain amount that differs with each loan. So let's say we have it's called a 5-to-1 ARM. That rate will stay fixed for 5 years, and then it will adjust every year after that 5-year fixed period. But why is that good? For those first 5 years, you're going to get a lower interest rate, and maybe you'll qualify for a little bit more house. Great. We get you into a house. You're probably not going to be keeping that loan that you get regardless, which is why ARMs are a good idea, because rates are high right now. That's no ifs, ands, or buts about it. But we're going to keep that loan for probably 2 years, much less than our even 5-year fixed period. We're going to refinance you to a 30-year fixed rate at 4%, which is even better than you're going to be getting at your, on your ARM, and you're going to be locked in for 30 years on that. It's going to be great. It's going to be good times.
So you just basically, you get an ARM now, but then, yeah, like you said, you just refinance later.
Right. So ARMs have it's called a teaser rate, or a starting rate that is lower than what a 30-year fixed rate would be for the same type of loan. So, you have a lower payment for that time frame, and after that, you're going to be refinancing to a lower interest rate and getting those costs down, saving some money, but you're saving money in the meantime by going with that adjustable rate.
Gotcha. Okay. Did you have any more slides you wanted to talk about?
This was my last slide I wanted to talk about. Let me go back to this one real quick. This was just a little snip of my market watch. The only piece on this that I wanted to touch on is that there is less demand than there previously was. There's no doubt about that, but there's still a lot of demand in comparison to what it has been previously. The market is still hot, like I've said probably 1,000 times in this so far. But why is that good? That means that the sellers don't have as much power. They're not able to list their houses for $50,000 over what it's actually worth. So they have to list their houses at a reasonable price, or a fair value price, and they're still selling quickly. So that's awesome. You're getting a better deal on the house. You're getting it for a more reasonable or achievable price, and you're going to be able to see that appreciation rather than having to pay a big premium over what it's actually worth, just because you're in a seller's market and there aren't enough people listing their homes. Now there's enough homes to compete.
Great. And so good for buyers, not so great for sellers.
Yeah, exactly. If you're a seller in this market, not quite so good for you. But the good news is that if your house is still listed properly, with a good price, it's still selling fast, which is still good news for sellers overall. But you're just not seeing the same numbers that you were getting when there were no houses on your block that were even being listed. So you could basically list it at whatever you wanted to and still get offers. You have to be competitive now.
I'm finding one of our issues too is even identifying where we should be pricing in
Yeah.
terms of how quickly prices are dropping or homes are sitting.
Mhm.
And what I try to do is create sort of a timeline based off of each price range, how long you can kind of expect it to sit to sort of make sure that, people understand and that we have expectations. And
Right.
for sure, like you're saying right now, the expectation of selling your home over the weekend for, $50,000 over what what a normal price would be. It's a little harder.
It's
Um,
yeah.
yeah, yes. My other question is, and because we saw down payment assistance, we sort of saw that go away temporarily. Like where is that at as far as FHA, DPA?
That is one thing I'm actually very happy to talk about as well is the past 2 years, if you were trying to submit an offer with an FHA loan or a down payment assistance loan on top of that, your offer was 99.9% not going to get accepted. Let's be real on that. Every offer that would
I
get
can
accepted,
let me make sure I touch base on that.
yeah,
So what Greg's talking about is when we submitted an FHA loan with our bid we submitted a bid that was an FHA loan. A lot of sellers, because they had so many opportunities, so many people wanted their house, they would only choose conventional. Your type of financing is not a protected class. So even if you're a veteran and you have VA financing, they can say, we don't want to do VA. The reason a lot of sellers don't want to do VA or FHA is because it's sold to the government. It's sold to a government entity that the government doesn't want to lose money on the home that you're purchasing. They don't want you to purchase something that's not worth the money they feel it's worth. So the appraisal process is actually a little bit more aggressive under the FHA VA guidelines. You may have to make repairs to the house versus conventional. It's kind of wide open. It's not as particular about, because the conventional loans go on the open market. They're not sold to a government entity. Is that correct, Greg?
yep, that's exactly right. So in the past 2 years, and thank you for clarifying, by the way, FHA loans and VA loans, USDA, any loan that's sold to the government is going to have stricter guidelines in terms of what appraisals have to be and what has to be shown on them. So it's been very difficult to get an offer accepted if you're somebody who falls into that category, and maybe you don't have cash to buy the home, or maybe you don't have the availability to get a conventional loan, whether it's from credit, down payment, or what have you. So one thing that I've been working with so much more recently, and I'm very happy about it. You're muted, by the way, but I'm so happy about it.
That's backwards. Everything's backwards. Yeah,
Oh, true.
basically government, FHA, VA, and then investors is conventional, private, basically everything else, right? You can sell everything else on the open market.
Right. So now we can get FHA loans accepted because there aren't five bids on a property by the time it goes to Saturday, right? So we're able to submit an offer with down payment assistance. We have a much higher likelihood of that offer getting accepted. That doesn't mean it's going to get accepted every time. The seller still has to, approve of that bid before going through with it. But your odds of getting accepted, if you're somebody who falls into the need of down payment assistance, or you need an FHA loan, or you need 100% financing on a VA loan, you are in a much better place than you were 3 months ago. And that's one reason I don't fall into any doom and gloom about the housing market slowing down, because it's still very hot, first of all, and there are lots of people who have been trying to buy a house for the past 2 years but just can't get a conventional loan or get the most competitive offer. So those people are going to be entering the market much more now. So if you're a first-time home buyer, you're in a much better position now than you have been in the past 2 years, for sure. Even with rates higher, you are in a much better position because you can actually get an offer accepted.
Yep. Okay. Now in terms of DPA, what's available? What's out there? What can people do?
So there are multiple different forms of DPAs. Two of the most common ones that we have been working with are the FHA Chenoa Fund program, which the FHA Chenoa Fund program is great because it covers the minimum down payment on FHA loans, which is 3.5%. But we also can get you a little bit more money on top of that, up to an additional 1.5% to cover some of your closing costs. So when you're getting a mortgage, of course, there's your down payment, but there are also title fees, escrows that you have to have deposited for taxes and insurance, and other closing costs that are associated, whether it's processing fee or what have you. There are different things.
Another thing we're seeing, I know, is now, which traditionally is pretty normal, but sellers are starting to help out with closing costs, right? Contributing a percentage or whatever towards the buyer's closing costs.
Absolutely. And that's another thing about the market slowing down that's very beneficial for our buyers. It's not a complete seller's market. So buyers have more power in this market when they are submitting an offer. Not only can you get an FHA loan accepted more often now, but you can also negotiate and get that seller to pitch in a little bit of money for your closing costs. And especially for our people who are falling into the category of needing down payment assistance, we want to get some of that money towards closing costs so we can get you into that house for virtually, I don't want to say $0, but as little as we possibly can.
Right. Yeah. And so essentially what's happening is it's just getting easier. It's actually getting a little easier to buy a house.
It is. And and that's why I say it all depends on who you talk to, because you can see the doom and gloom of housing market, but if you look at it from the perspective of somebody who has only been qualifying for an FHA loan or FHA down payment assistance loan, this is your market right now. We're coming into the best time for you to buy a house, because in the last 2 years, you have had no power. You have had no ability to buy a house unless you were already selling one of your own and could buy another one cash.
So what happened with the DPA for a little while? Because I noticed that it did go away for a little while, right? Like a month or something like that.
Yes. So with those charts that we were looking at, with rates skyrocketing, they just couldn't keep up. And there are down payment assistance programs that are still out right now, the Arizona Home in 5 being one of them. It was hard to get a down payment assistance loan when rates were just so expensive that there was no financial benefit of you getting that. If it's covering your 3.5%, or if it's covering, part of your down payment, but it costs you 2% of the loan amount in fees just to be able to get an interest rate, then that takes the vast majority of your benefit from the get-go. So rates have to be stable. They have to be able to have the funds to provide down payment assistance. That's another issue that some down payment assistance programs were running into, is that they're just running out of funding. And I couldn't tell you where these programs will be tomorrow. Basically, it's when they run out of funding, they run out of funding, and there's nothing we can do about it. But overall, yeah, it was hard for a while for down payment assistance programs to keep up with the rising rates, and it didn't necessarily matter anyway, because you weren't going to get an offer accepted with that program to begin with.
Yeah, that's really true. So if the DPA program's 3.5%, so the way I'm kind of viewing it right now is if you can get that from the seller, 3.5%, that would I mean that kind of replaces the DPA or even doubles it. Correct? Is it, because if I pull 3.5%? Okay, explain that.
No. So the seller can contribute towards your closing costs. They cannot cover your down payment on the home. So that down payment either has to come from you, that 3.5%, or it has to come from a down payment assistance program, which is in the form of a second loan of sorts. A seller can contribute money to cover the rest of those costs, cover different things, repairs on the home, whatever you want, but they cannot cover your down payment for the loan.
Gotcha. Okay. They can only contribute to closing costs. Good to know.
Exactly.
So really, we actually have a pretty good home buying environment now. It sounds like realistically, as we move forward, it sounds like things are going good. It's just adjusting. A lot of people are, readjusting their perception of the market and what's happening. And
Yep.
that makes sense. As we are fixing inflation here, houses normally don't sell in 15, 16 days over the weekend. And
Right.
that's getting fixed.
Yep, exactly. I think the market is coming. I'm not even going to use the term coming down, because it's not coming down, it's calming down. Um, it's unrealistic to believe that we can see the appreciation numbers that we have seen over the last 2 years every single year. No, if it continued at that pace, there would be no affordability for these homes. And then the exact same thing would happen that we're having right now, where the market slows down significantly. Because if you don't have anybody who can afford these homes, there's no way you can have appreciation, right? It's impossible, unless, just corporations are buying homes, but that's not the case overall.
Yeah, no, we don't want any more of that.
We don't want any
Okay.
more of it.
All right. Well, no, that sounds good. It was anything. I mean, I feel like I got a lot of more information on what's going on. Is there anything else you wanted to add or anything like that?
I don't know if there's much more I want to add. I feel like I gave a pretty decent
Yeah,
rundown
you
of,
got
like,
it covered. You took care of us.
yeah, I've got you guys
Appreciate
covered.
it.
If there's anything that you think I didn't cover, just give me a call or let me know. I'm happy to go over whatever you need.
I will. I'm going to include all your info, of course. Mr. Greg Siderakis, definitely the guy to call and get some information, and a good friend to have in the financial world, that's for sure. And so I'll definitely put out all your information, Greg. And of course, I always recommend, to start talking. I mean, that's the thing. I think people are always kind of hesitant to talk to lenders because they feel like, oh, they're going to pull my credit or what. I'm not ready for that. And the way I explain it, Greg, like you've explained it to me, is really, you get, for one, you get kind of a window where the credit bureau recognizes, hey, you're looking for, rates for the biggest asset of your life. Like they're not going to ding your credit horribly for shopping around and using your credit, for what it's for. And then also you need to be able to advise. You need to be able to give them assistance in understanding what they should be working on, and what, based on their financial goals, how to get where they want to go, right?
Exactly. At the end of the day, I look at us all as a team, whether it's my client and I, or Chris, my client and I look at us all as a team together, because guess what? We all have the same end goal in mind. We all want to get you into a house at the end of the day. We all want to get you in the best financial position possible. So how do we do that? And that's what I try to help figure out, is not only am I just doing a loan for you, I'm trying to help you plan going forward to achieve the goals that you want. If your goal is to, buy a home for the first time and be, the first homeowner in your family, we want to help you achieve that goal, and we want to do the best job we can at it. So we want your finances to be up to par, ideally.
That's exactly it. We're all on the same side. All right, Greg. Well, I sure appreciate everything. And like I said, your contact information, everything will be below. And I sure appreciate your time, sir.
Yeah, thank you, Chris. I appreciate you having me on.
Hey, for sure. Thanks so much.
All right, thank you. Have a good one.
You too. Bye.
Bye-bye.